Welcome to the Deep Dive. Today, we're looking at Wynn Resorts, ticker WYNN. Now, this is a name everyone associates with top-tier global luxury. Right now, it's trading around $119.89.
And it's at a fascinating point, really. Maybe the biggest strategic pivot in the company's history.
Absolutely. The core question, the real conflict here is huge. Can Wynn actually pull off this move into the UAE? It looks like a monopoly, a totally new gaming market for them.
Right.
But can they use that to drive growth while, juggling $10.5 billion in debt and still being so heavily tied to Macau?
That sums it up perfectly. Our goal here is simple. We want to give you, the listener, a shortcut, a way to quickly grasp the fundamental analysis of WYNN.
Yeah.
We've synthesized the latest research, the financial data. We're really focusing on what matters now, understanding the risk-reward balance for a company making this kind of multi-billion-dollar bet.
The stakes really couldn't be higher. Okay, let's dive into part one. We'll look at the company's foundation, starting with the core business. Chapter 1, business analysis. So at its heart, Wynn develops and manages these super high-end integrated luxury resorts. They're not chasing volume. They're targeting the ultra-wealthy. Everything's about opulence, world-class service, and that lets them charge premium prices.
Yeah, and while most people think casinos when they hear Wynn, it's really that integrated resort model that defines them. If you looked at the projections for fiscal year 2025,
Okay.
gaming, yeah, it's still the biggest piece, projected at 57% of revenue, but the non-gaming parts are crucial. Rooms are projected at 19%, food and beverage also 19%.
Just almost 40% combined.
Exactly. It shows they're not just about the gaming floor, they're a major hospitality player too.
And that focus on, unparalleled luxury, that's their economic moat, right? It lets them keep those premium prices.
It really is.
And you see it validated externally. Wynn's won more Forbes Travel Guide 5-star awards than any other independent hotel company out there. That kind of brand reputation is incredibly tough to copy.
But here's the interesting twist, or maybe the historical weakness hiding in that strength.
How so?
Well, because they were so strong in certain areas, it led to massive geographic concentration risk. Before the pandemic, an incredible 76% of Wynn's pre-tax earnings, their EBITDA, came just from Macau.
76%?
Yeah. But management knows this. They're deliberately trying to shift away from relying so heavily on Macau. They're actively building what they call a three-pillar global enterprise.
Okay, 3 pillars. What are they?
So you've got Macau, which is recovering but still volatile. Then there's Las Vegas, stable, high margin. And the third pillar, the big game changer, is this new UAE market.
Right, the Wynn Al Margin Island project.
Yeah.
And that's where the competitive edge is now, isn't it? Because they got the first license.
Precisely. It's the highest barrier to entry you could ask for. They were the first mover, giving them a temporary monopoly in a wealthy region that hasn't had integrated resorts before.
Untapped potential.
Exactly. And there's another tailwind helping them, actually. Back in Macau, there's a big regulatory change happening. These smaller satellite casinos are being phased out by the end of 2025. And that naturally pushes market share towards the big established players like Wynn. It consolidates the market for them.
Chapter 2. Management evaluation. Okay, let's talk about who's in charge. Craig Billings became CEO in February 2022. And it's important to remember this leadership team is operating after the founder scandal back in 2018.
Right, a governance overhaul.
Yeah, so it feels like a shift away from being founder-led towards a more, let's say, professional, institutional style of management.
And you can see that reflected in their capital allocation strategy. It seems disciplined. They're being aggressive, yes, targeting growth, but they're balancing it.
How so?
Well, the biggest, most aggressive move is clearly that $5.1 billion UAE resort. Wynn's putting in over $1 billion in equity themselves.
Huge commitment.
It is.
Yeah.
But contrast that with their decision to pull out of the race for a New York casino license. That was looking very expensive, very competitive, uncertain outcome.
So they walked away.
They walked away. It suggests their focus on risk-adjusted returns, not just growth at any cost.
And we saw that discipline again with their reaction to those 2025 U.S. tariffs, right? The sudden 10% duty.
Yes, that was a key moment. Management immediately halted $375 million in U.S. capital projects. Things like the planned Encore Tower remodel in Vegas.
Why? Just the cost.
Primarily, yes. They cited the higher material costs and just the general uncertainty. It was a defensive move, really, to protect the company's expected returns in a shaky environment.
Makes sense. Conservative.
And the numbers seem to back up this disciplined approach. Look at return on invested capital, ROIC. The trailing 12-month figure is 10.90%.
Okay, is that good?
Well, here's why it matters. It's comfortably above their weighted average cost of capital, their WACC, which is 7.73%.
Ah, so the investments are earning more than they cost?
Exactly. Especially crucial when you're carrying over $10 billion in debt. You have to show you're creating value with the money you invest. And they have also returned significant cash to shareholders, over $1.35 billion in buybacks and dividends since 2022.
Hashtag Tech Chapter 3. Financial analysis. All right, let's dig into the financials. The recent past has been, well, a roller coaster for Wynn. Revenue collapsed 68% in 2020.
Yeah, the pandemic hit them hard.
Then surged back 73.9% in 2023. Last year, 2024, it settled around $7.13 billion.
And the profitability on their core services is actually quite strong. Gross margin is impressive at 68.32%.
Okay.
And they are generating decent cash.
Yeah.
Trailing 12-month free cash flow, FCF, is about $743.4 million.
And this feels like the elephant in the room.
Yeah.
The balance sheet. That's where the biggest risk seems to lie, right?
It raises a very important question, definitely. How do you square these high-end luxury assets with such a complex leveraged balance sheet? Total debt is huge, over $10.5 billion.
And the negative equity.
Yes, that negative $1.21 billion in shareholder equity. It looks alarming, but we really need to clarify this for listeners.
Please do.
It's largely an accounting outcome. It reflects the big losses they booked during the pandemic shutdowns, plus the money they spent buying back their own stock since 2022. It doesn't automatically mean they're about to go bust.
So it's not a sign of operational failure right now?
Not necessarily, no. Because of that accounting noise, metrics like PE based on earnings can be skewed. That's why looking at something like enterprise value to EBITDA, or EBITDA, is often more useful here. That's currently around 13.22x. It gives a better sense of the operational valuation relative to earnings potential before interest, taxes, depreciation, and amortization.
Okay, 13.22x EBITDA. But what about the standard PE ratio, the market pricing? TTM is about 35x, forward PE is roughly 23x.
Right.
That seems high compared to competitors like Las Vegas Sands at 26x or MGM at 18x forward PE.
Oh.
Are investors paying a premium for Wynn right now?
It certainly looks like it. The market seems to be pricing in a lot of optimism, especially around that UAE project.
But that project won't even open for a few years. Is the market getting ahead of itself? Are we pricing in perfection already?
That's the million-dollar question, isn't it? Or maybe the $5 billion question here.
Yeah.
The market is clearly betting on the huge potential value of that monopoly in the UAE. But you're right, they are paying for success before the doors even open. That premium suggests investors are willing to look past the $10.5 billion debt if, and it's a big if, that UAE development stays on track.
So the premium is essentially the entry fee to get exposure to that UAE growth story early.
That seems to be the market's logic, yes.
We're definitely deep in the weeds with data here.
Yeah.
We want to make sure you always get priority access to our analysis like this. Please like and subscribe to Stock Analytics AI. For €4.99 a month, members get priority deep dives on tickers. We're actually covering all the S&P 500 stocks over the next few months, and members get that exclusive priority access. And if you just want this specific deep dive or another one-off, dropping us a super thanks is always appreciated.
Okay, let's switch gears now. We're moving into part 2. Here we'll look at how the market perceives Wynn, some really interesting ownership details, and crucially, the risks that could throw a wrench in the works.
Hashtag Chat Chapter 4, Market Sentiment. So how is the market actually feeling about Wynn overall? What's the general vibe?
Well, broadly speaking, sentiment is positive. Analyst ratings are pretty consistently in the moderate buy to strong buy range. In fact, 14 out of 17 analysts covering the stock rate at a strong buy.
That's quite bullish.
14 out of 17, okay. Strong consensus.
Yeah, and the technical charts seem to back that up too. Short interest, which is basically bets against the stock, has dropped by over 14% recently. That suggests the bears are backing off.
Fewer people betting against it.
Right. And then there's what's called the golden cross formation. This is when the shorter-term moving average, typically the 50-day, crosses significantly above the longer-term one, the 200-day.
But what does that signal technically? It's generally seen as a strong bullish signal, indicating sustained upward momentum in the stock price. So the market signals seem aligned with the analyst ratings right now.
Hashtag Chapter 5, Ownership Structure. Okay, let's look at who actually owns Wynn stock. Institutional ownership is high, as you'd probably expect, somewhere between 70 and 89%.
Pretty standard for a company this size.
But here's where it gets really interesting. The insider holdings, specifically the single largest stockholder. Any guesses?
Not off the top of my head.
It's Tillman Fertitta. He owns 12.3% of Wynn Resorts.
Tillman Fertitta, as in the owner of Golden Nugget Casinos, a direct competitor.
That's the one. He's the largest single shareholder in his competitor's company.
Wow, okay, that is unusual. What does that signify? It's like a competitor activist situation.
Exactly. What's your take on that?
Well, on one hand, his massive investment is a huge vote of confidence, right? He clearly sees significant value in Wynn's assets. He must believe the brand, and especially that UAE license, are either undervalued or set for major growth. He knows the industry inside out.
So it's a bullish signal from someone who should know.
Definitely. But on the other hand, being an activist and a competitor gives him leverage. He could potentially pressure Wynn's management, maybe push them to return more capital faster, or even advocate for specific strategic moves down the line using his industry knowledge and ownership stake. It adds a whole layer of intrigue.
Hashtag Chapter 6, risk assessment. Okay, we've talked a lot about the upside, the UAE, the brand. Now let's get real about the risks. The SWOT analysis highlights the key trade-offs, doesn't it?
It really does. You have clear strengths, that premium brand, the temporary UAE monopoly, but they're up against significant weaknesses. The ongoing Macau concentration risk and that highly leveraged balance sheet, the $10.5 billion in debt we keep coming back to.
And what about the external threats, things outside their direct control?
Well, connecting the dots, the big external threats really amplify those weaknesses. Rising interest rates are a major one.
Makes that huge debt pile even more expensive to service.
Precisely. And then there's geopolitics. Any increase in U.S.-China tensions creates uncertainty for their Macau operations, which are still incredibly important even with the diversification efforts.
Let's circle back for a second to those 2025 U.S. tariffs. You mentioned them earlier, but the impact seems quite specific and, frankly, fascinating.
It really is a great example of unintended consequences. So the tariffs, that 10% universal duty, directly hit the cost of construction materials for U.S.-based projects.
Right, which led them to halt that $375 million in domestic capex, like the Vegas remodel.
Exactly. But here's the insightful part. By making U.S. investment more expensive and uncertain, this U.S. trade policy inadvertently created a strong financial incentive for Wynn's management.
An incentive to do what?
To reallocate that capital away from the U.S. and towards their big international projects, specifically the UAE resort, which isn't subject to those same tariffs.
So the U.S. policy actually pushed them faster towards their international pivot.
It effectively accelerated their existing strategy, yes. This external macro shock ended up reinforcing their move towards global, non-U.S. growth. It's quite something.
That is a huge takeaway. A domestic trade policy potentially funneling hundreds of millions towards an international project. Amazing. Hashtag chat chapter 7. Conclusion. Okay, let's try to bring all these threads together. If we lay out the bull case versus the bear case, what are the core pillars?
All right. For the bulls, I see 4 main pillars. First, the unrivaled brand moat, that luxury positioning. Second, the monopolistic UAE growth engine, massive potential there. Third, the new disciplined capital allocation strategy we discussed. And fourth, the strong underlying financial recovery post-pandemic.
Strong case. But what about the bears? What are the main arguments?
The bear case also rests on 4 key risks, I'd say. 1, the persistent Macau concentration risk despite diversification efforts. 2, that leveraged balance sheet, the $10.5 billion debt overhang. 3, ongoing macroeconomic headwinds like interest rates and geopolitical risks. And 4, the current premium valuation, which, as we said, seems to already price in a lot of future success.
We did run an educational discounted cash flow, a DCF model.
Yeah.
Just to try and quantify those expectations. What did that suggest for intrinsic value?
Yeah, our educational model yielded an estimated intrinsic value range of about $130 to $150 per share.
Okay, compared to the current price, around $119.89.
Right, so that suggests the stock might be slightly undervalued or perhaps fairly valued right now, but, and this is crucial, that valuation is highly sensitive. Any significant delays or cost overruns with the UAE project, or if the Macau recovery stalls out, those intrinsic value numbers could drop pretty quickly. It assumes strong execution.
But wrapping it all up, the whole investment thesis seems to boil down to one core question.
Which is?
Can that unique first-mover growth from the UAE actually generate enough value quickly enough to outweigh the risks? Specifically, the rising cost of carrying that $10.5 billion debt and the ongoing reliance on Macau.
That's exactly it. It's a race between the new growth engine and the existing financial and geographic constraints.
All right, before we sign off, here's something for you, our listener, to think about. A final provocative thought.
Yep.
If Wynn's big bet pays off, if the UAE project is a massive success, how might Tillman Fertitta, the competitor activist with that huge 12.3% stake, leverage his position? Could he push for integrating assets across the industry? Or maybe use his influence to force an even bigger strategic shakeup down the road, given his deep market expertise? Something to mull over.
Definitely food for thought. And just before we finish, the essential disclosure. This analysis was generated by an AI system. It's intended for educational purposes only. It should absolutely not be considered financial advice.
Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.